Hi, I'm Bob French. We're constantly inundated with news about what the markets are doing. Now, day-to-day market movements are basically just noise. But even ignoring that, the market is basically a magic box to most people. If the markets went up today, you have more money than you did in the morning. And if it went down, you have less money than you did in the morning. But it just sort of seems random why the markets go up or down. Now, we all know that the stock market is tied to the economy. Sort of. If good things happen for the economy, then the market will go up. And if bad things happen, then the market will go down. Sort of. In reality, the stock market is correlated with the broader economy, but it's not really the economy. That said, you can think of the market as a forward-looking, long-term measure of the broader economy. So what does this mean? Well, let's think about what a stock is. A stock is a claim on the future dividends that a company will send out. And its price is how much the market is willing to pay for that future stream of potential dividends. As we're thinking about stock prices, it's easy to think about the market as this omnipotent, cohesive thing dictating prices from on high. But that's almost exactly the opposite of what's going on. The market is really a huge group of individual participants all trying to make money for themselves. And crucially, they don't all agree with each other. No one would buy or sell stocks if everyone agreed on the price. If we both think that Ford is worth $5 per share, well, why would we bother trading? The only reason anyone is going to buy or sell a stock is if we disagree on the price. If you think that Ford is really worth $4, you'll be more than happy to sell me your shares at $5. And if I happen to think it's actually worth $6, then I will be equally happy to buy them for $5. Markets don't exist without this disagreement. But it's important to recognize that these basic disagreements are not about the facts of the company. We both know how much money Ford made last year and how many trucks it sold or whatever other quantifiable facts you happen to care about. The disagreements are about what those numbers and everything else, the rest of the company's sector, the broader economy, general sentiment, etc., say about what will happen next. When you strip it all the way down, the disagreement is about how much the company will kick out in dividends and how uncertain that dividend stream is. Well, all of these people are valuing different companies based on guesses of what the future will look like. And as we get new information, the news, they update those guesses about the future to reflect this new information, which means they'll end up with a new price. And the market price, the price that you can go out and buy or sell that share of Ford for, is just all of these different people coming together and basically putting their money where their mouth is. If they think a stock is selling for less than it should be worth, then they'll swoop in and buy it, driving the stock price up. If they think a stock is overvalued, then they'll sell the stock, driving down the price. But the point is that the news is the crucial part. Prices, whether for stocks, bonds, or anything else, move based on new information. And crucially, it's about how that new information squares with all of what the market participants expected. It's not necessarily about whether the news was good or bad. It's about whether the news was better or worse than expected. And this also includes simply eliminating the possibility that a good or bad thing could happen. So what does this mean? Well, it means you can't time the market. In the short term, it's pretty much a coin toss whether the markets will go up or down on a certain day or week or month. We are able to make pretty reasonable assumptions about what the world will look like in the short run. It's one of those situations where we know that our guesses will be wrong, but we aren't consistently wrong in one direction or the other. On the other hand, though, in the long run, the markets do tend to go up. We wouldn't be investing in the stock market if that wasn't true. A good way to think about this is that the market prices are the collective wisdom of all the market participants' best guesses of what the future will look like, given everything that we currently know. It's probably going to be wrong, which is why the markets move, but in the short run, we don't know if those prices are too high or too low. In other words, ignore the short-term noise and focus on harvesting the long-term returns that the market puts on offer. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this or any other questions that you would like me to answer, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.